Welcome to the Kemp IT Law vlog. I'm Nooreen Ajmal, and this vlog looks at a recent study on machine learning in the financial services sector. A joint study by the Bank of England and the FCA was published on the 16th of October 2019 and is the result of a survey of almost 300 financial services firms. Whilst the study was not statistically representative of the entire UK financial system, it did make some interesting findings. First, the report found that machine learning is increasingly being used in the UK financial services sector. 2/3 of the institutions asked said they were already using ML. Second, ML has passed the initial development phase in a number of cases, and 1/3 of those asked said they are using ML for a considerable share of their activities in a specific business area. The most advanced deployment of ML being in the sectors of banking and insurance. Third, ML is being used across a range of business areas from front office to back office. ML is most commonly used in anti-money laundering and fraud detection. It is also being used in customer-facing applications for customer services and marketing purposes. Another key finding was that whilst regulation is not seen as an unjustified barrier to ML deployment, some firms did stress the need for additional guidance on how to interpret current regulation in this field. It was further found that the biggest constraint to firms in using ML are actually internal, such as legacy IT systems and data limitations. Firms also thought ML doesn't necessarily create new risks, but rather could be an amplifier of existing ones. For example, ML applications not working as intended if model validation and governance frameworks do not keep up with changes in technology. Other key findings of the report were that firms use outcome-focused monitoring and testing against benchmarks as the most common form of validation methods, and they validate ML applications before and after deployment. Firms use a variety of safeguards to manage ML risks. Most commonly used are alert systems and human-in-the-loop mechanisms, that is, getting human feedback into the learning loop of the machine. It also found most firms design and develop their ML applications in-house, but they sometimes rely on third-party providers for underlying platforms and infrastructure, like cloud computing. And finally, the majority of users apply their existing model risk management framework to ML applications. Whilst there is a long way to go in understanding the true impact of ML on the financial services sector, the report is a useful insight into how it is already playing its part. If you'd like to find out more about machine learning, AI, or financial services tech issues, please check out our vlogs, blogs, and white papers at kempitlaw.com.